Did you hit your earnings target? What kind of margin are you getting? Many people focus on the income statement.
The statement of cash flows is sometimes viewed as the more mysterious cousin. This is a shame because it can be extremely informative and is important to monitor.
After all, without the ability to generate cash, a company can't pay its bills, and that doesn't usually turn out well. Think about it. You start the period with an opening balance sheet, a list of what you own, your assets, what you owe, your liabilities, and the equity residual. There are three types of transactions that account for the changes between the opening and the closing balance sheets. The first is a shuffling of the balance sheet components. If you receive inventory and haven't paid your supplier, you have more asset inventory and more liability accounts payable.
No expense has been incurred on the income statement, reducing the equity account retained earnings, and no cash has changed hands.
The second is an accrual change affecting the income statement and balance sheet. If you perform a service for a customer who will pay you later, you have more asset accounts receivable and more revenue on the income statement, increasing retained earnings. But again, no cash has changed hands. The third is cash flow change. When you pay your bill, you have less cash and less accounts payable. There is no income statement effect.
When you receive the customer payment, you have more cash and less accounts receivable.
Again, no income statement effect. When you pay your accountants their well-deserved salary, you have less cash and more wage expense on the income statement, reducing retained earnings. The balance sheet, income statement, and statement of cash flows are all affected.
Imagine the income statement and the statement of cash flows dropping into the balance sheet,
explaining how you got from where you started to where you ended up. The statement of cash flows contains three main sections. Each links to particular parts of the income statement and balance sheet. The first is cash flows from operating activities. No, not that kind of operation. These are cash flows from your day-to-day operation of your company. The section links revenues and expenses with the related current assets and liabilities. Remember, changes in the balance sheet can be explained by the income statement and statement of cash flows together. Comparing the profit and loss from operations to changes in working capital balance sheet accounts show what the operating cash flows were. The second is cash flows from investing activities. This shows how your company has used cash for capital purposes, to buy and sell land, equipment, and other long-term assets that provide the production capacity to handle operations. The third is cash flows from financing activities. This shows your company's cash flows from the long-term business financing needed to obtain capacity, such as paying dividends, taking out long-term loans, issuing stock, all the cash flows associated with the long-term liability and the equity sections of the balance sheet. There's a bonus section at the bottom of the statement of cash flows that details major non-cash investing and financing transactions, such as the settling of a long-term loan with newly issued common stock or with assets instead of cash. Even the statement of cash flows presents some non-cash information. All companies need to present each section, and everybody's investing, financing, and bonus sections will follow the same format. But for the operating section, you can choose one of two ways to present the information: the direct method or the indirect method. The most popular, because it's the easiest to create, is the indirect method. It starts with net income and proceeds through two steps. First, you adjust income for all the non-cash items, adding back depreciation and amortization, adding back losses and subtracting gains from disposals and investments, and so on. Then, the changes in current assets and current liabilities are added and subtracted as appropriate. Decreases in current assets and increases in current liabilities are added because they represent net cash in. Increases in current assets and decreases in current liabilities are subtracted because they represent net cash out. For example, if the balance in accounts receivable decreases over the period, you have a net cash inflow because more old customers paid you than new ones owed you money. If the balance in accounts payable is lower at the end of the year, on net, you must have paid more old bills than incurred new ones, a net cash outflow. In the other direct method, each income statement item is linked with the specific current assets or current liabilities that relate to it. For example, revenue has two related balance sheet current accounts: accounts receivable and unearned revenue. This is because of the potential for a timing difference between when the company recognizes revenue and when it collects cash. A company could be paid in advance at the same time as they deliver on their promise, or after the task is completed. If they're paid in advance, they have a cash flow that isn't included in revenue. If they're paid afterwards, they have revenue that isn't cash yet. So to figure out how much cash is actually collected from customers, the company needs to adjust the revenue amount for changes in unearned revenues and accounts receivable. Another group includes cost of goods sold with inventory and accounts payable. We find appropriate groups for the rest of the operating expenses, current assets, and current liabilities. The direct method is more complicated to produce, but it more clearly provides useful information about cash collected from customers, cash paid to suppliers, and other components of operating cash flow. The cash flow statement is an important part of financial reporting. Companies might have a lot of profits, but not a lot of cash flow, and vice versa. This could be a signal of trouble on the horizon or a signal of fraud. Don't ignore this statement. Looking at all the statements will give you a better sense of how a company is doing and provide valuable insights into its future performance.